Have faith in your mind, have faith in your grind, invest in yourself, transform in your time. Have faith in your mind, have faith in your grind, invest in yourself, transform in your time. Trading get paid, trading get paid, trading get paid, trading get paid, trading get paid. Oh yeah, trading get paid.
It's easy to tell a beginner to be disciplined. It's easy to take a look at the chart and say, do the right thing. But what is the right thing? Let's talk about it. Joe here with Trading Get Paid, and let's talk about risk management. It is the most important thing as we practice our discipline that we're gonna do in the market. It's more important than the strategy you choose to take. Risk management needs to be a strategy in itself. This is what you should do. Number one is your risk to reward. When you find a trade to get into, you need to first look at how much risk you're gonna have. If this is the risk and this is the potential reward, then we know that we're doing good. I would not want to risk $1 to get 50 cents. I don't want to risk $1 to get 20 cents, but I will risk $1 to get $2 or more. In this case, I'd be risking $1 to get nearly $3. That sounds like a good deal to me. Make sure that your risk to reward is at least 1 to 2, 1 risk to 2 reward. Number 2 is position sizing. You need to know how much money you're supposed to risk in every trade. So I would recommend to everybody to not risk more than 1% in every trade you take. That means, let's assume you have $1,000 in your account, and here is your stop loss. So you have a 10 pip stop loss right here, and you have $1,000. So what should your lot size be? Well, 1% of $1,000 is $10. You are risking 10 pips. So your lot size should be $1 for every pip you risk. If you use a $1 lot size and you lose this trade, you will lose $10. That is how you'd use risk management, 1% of your account. Number 3 is, probably should be number 1, your stop loss is your best friend. You should not be trading without a stop loss. I can tell you about take profits and I can tell you about strategies, but I'm telling you now, you need to make sure you understand how to set a stop loss. You should make sure that your stop loss makes sense according to market structure. Don't set your stop too tight and don't risk too much by setting your stop too loose. You need to have a stop loss. Your stop loss is your best friend. Those are just 3 ways that we can practice risk management, but there's so much more. If you want to learn more about that, go to my YouTube channel and watch the videos I talk about risk management and how to build your strategy. Go to Trading Get Paid, hit that subscribe button, and check out the content. Let's unlock the secret of consistent success. We said the most important thing is discipline. And how do we do that? Through risk management. But how do we become consistent? It's mastering our trading psychology. Let's talk about it. I'm Joe. This is Trading Get Paid, and I'm gonna give you 5 tips about trading psychology. Number 1, trading is an emotional roller coaster. When you win, it feels great. When you lose, it's miserable. And you have to be able to master that. You can't let your highs get you too high and your lows get you too low. You gotta just remain consistent. Stick to the plan. How do we do that? We have rules in place that we follow to get in every trade. We don't make any trades that don't meet our criteria. Number 2, patience and discipline. You have to be patient. You can't force it. When you see a trade that you like and you want to get into the market, wait for your confirmations. Wait for the trade to activate. Make sure that you have volume candles and make sure you follow your rules. Don't get impatient. Don't try to push it. Don't get in early. Don't try to hold on too long. You have to have patience and discipline to know when to get in and to know when to get out. And that's why I always tell people to have a set of rules. Have a trading plan and follow it. Number 3 is you have to accept the fact that there's losses in Forex. When you trade, you are going to lose. I've been trading for years now. I am a master trader. I lose sometimes. I take losses, but I accept it. And here's why. Because I know that I have practiced proper risk management. I never have losses that wipe me out because I've mastered the art of staying at 1%. I use a 1% risk in every trade, so I know that even when I lose, even when the market does what I don't expect it to do, guess what? I've only lost 1% of my account, and I can always come back tomorrow and get it back. Don't revenge trade. Don't try to get your money back right away. Don't chase after bad trades and throw good money after bad. The best thing to do when you take a loss is to close your computer, walk away, and reevaluate. Come back at a better market condition. Number 4, confidence and consistency. I know it sounds like I'm saying trade plan a lot, but let me tell you, a trade plan is gonna be one of your best friends. If you have a set of comprehensive rules that you follow, then you have a guideline to stick to, and it builds confidence because you know, I have followed my rules, I've done the right thing. You will be confident and you will be consistent when you have a plan to follow. Don't try to do one thing today and a different thing tomorrow. Don't try to practice 3 or 4 different strategies at once. Don't try to do too many things. Don't try to trade too many pairs. Master something. Don't be a jack of all trades, be a master of one. Find a pair that you like, find a session that you like, find a strategy that works, use good risk management and master it and go kill these markets. Number 5, preparation. And it sounds like all these other ones were really important. They are. This might be the most important because to build confidence, to build patience, to build discipline, you have to do preparation. When you know that you've gone into the market and you've done the right research and you followed the rules and you know you've done the right preparation, you're less likely to start tinkering with the markets and trades. You're less likely to start jumping in early or late because you know I've already put in the work. I've already done the top-down analysis. I've already looked at everything I need to look at, and my preparation will build confidence in me to make sure that I enter the trade the way I'm supposed to. You will build confidence. Subscribe to my YouTube channel, Trading Get Paid, for dynamic content. Let me show you a little trick that's gonna get you into profit as soon as you get into the trade. Let's go. I wanna show you this little trick called divergence. What happens is you see the chart coming down and you see that the price is moving down right here. However, if you look at an RSI, you see that on the oscillator, price is moving up at the same level. So you see the same move happen. You see it spike right here in the middle, just like you see it spike in the middle here. The difference is that from structure to structure, price is moving down. However, strength is moving up. So what happens here is that even though price is moving down, strength is moving up. And so you know that there's probably a reversal coming. Once we get to that place, we see a nice entry right here. Why? Because we see the divergence and then the RSI line crosses the moving average. We see it right here. We enter the market. We have a really nice risk to reward, 1 to 2. We get in, and that is a beautiful entry for a divergence trade. Learn more tips and tricks to become profitable in this market by going to my YouTube channel, Trading Get Paid, and seeing all the great courses I have right there for you. Let's talk about volume. So you see there's a big push down right here. You see that these candles are big, they're flowing in one direction, there's clear direction, and there is strong movement. That is what we call volume. Now, when you look over here, you see that the candles are much smaller. There's less definitive direction, and that is what we call a lack of volume. Here you see volume pick back up to the downside, and that is where you see bigger candles, definitive direction, and that is really the definition of volume. What we have is, there is a lot of money being sold right here. So because of that, you see a big bearish move. In here, there's indecision, and there's about as many buyers as there are sellers, and there's not very many of either one. And so because of that, we have smaller candles without definitive direction. And then here you see where the sellers come back in, and there is a lot more money being sold again. And so here's where you see volume pick up. Now you can cheat, and this is not a bad thing. You can cheat. There is a volume oscillator. You can add it up here by going to indicators and just click volume, and you'll see these bars at the bottom of your chart. When you see that there's big movement, look, you see big red bars. When you see that the movement stops and there's no volume, look at how small these volume bars are. That's letting you know that there is no volume in the market. And then you see it pick back up, and look what happens. Boom, big move again. Anytime you see big moves in the market, you see less volume, boom, big volume. And there you go. We see this over and over all the time in the market. I don't necessarily think you have to use the indicator, but what you can do is just make sure that you are taking trades where you see volume. You do not want to be trading in this type of a market. You want to wait for price to give you a clear volume breakout. When you see a candle and a definitive direction that has more strength than the previous move, that is when you can get in and take good, solid trades where volume is in your favor. You want to know more about volume trading? trading, go to my YouTube channel, Trade and Get Paid, and hit that subscribe. Got a lot of content for you. So we're looking at GBP USD on the 30-minute chart. We have a nice push up, and then we get this triangle type pattern. Well, here's what's interesting. When you see when it comes up to the top here, it kind of rejects the top of the pattern, and there's no volume in the market. So when you get that rejection, then the first volume you see is bearish volume. So you're starting to wonder, maybe it's going to get a breakout. It does indeed get a breakout, and here's where you get your breakout entry. But in this particular case, when we think that a pattern is going to go to the upside, but instead it goes to the downside, we don't want to take the breakout. We want to be careful and wait for the retest, because it could be a fake out. In this case, what happens is we get a push back up, we get a retest, and you get a beautiful pin bar. There's your entry. Boom, we take it right back down to structure. Beautiful, beautiful trade, and more to come. It might end up going all the way down there, but we're just taking a safe trade to the first structure. 2-to-1 risk reward, 40 pips. That's how we trade a retest entry on a pattern that goes the wrong way. Let's talk about the Fibonacci retracement tool, one of the most commonly used and most powerful tools on all the Forex chart. In order to use a Fibonacci retracement tool, you have to have a high, a low, and you have to have a lower high, and that's when we're in a downtrend. The reason is because we have to have starting point and ending point. That's the purpose of a Fibonacci retracement tool. So let's see how it works. The first thing you're going to do is you're going to come up here and you're going to grab your Fibonacci tool right up here at the top on your TradingView chart. Once you have your Fibonacci retracement tool selected, you're going to start at the previous structure. You're going to click the screen and drag it down. You're going to want to come all the way to the bottom and show at the very bottom of your trend. So you have a move here and a move here, and you're going to take the Fibonacci retracement tool and drag it from the beginning to the end of the move. Here's a little pro tip. Don't just consider the horizontal zones only, but you want to also consider this diagonal line that you see here. Think of it as a trend line. You're going to take that and you're going to drag that right onto where your structure is and show that you have a full trend. You're going to drag it right onto the structure to show where a breakout could occur. So now you have a high, a low, and a lower high all marked by this Fibonacci retracement tool. Now check this out. You have all of these zones, and I'm going to show you my settings right here. Each one of these levels is very important. 0 meaning this is where it comes back to the beginning or back to the bottom of your structure. 100 is if it was 100% retracement. So in other words, if this was a retracement going all the way back up to the top, this would be a full reversal at 100%. The key area here is this golden zone. You can see it here in the yellow or the gold color. It's the 50% to the 61.8% levels, and that is your golden zone, the most powerful zone in all of the Fibonacci retracement. One of the ways you can use a Fibonacci retracement is by using this trend line. You can wait for a nice volume breakout. Once you have price come back up above the top, you can take this back toward the golden zone for a counter trend trade. Here's a little pro tip. When you get your Fibonacci set, look for the first candle right here that is closing below where the golden zone is. Drop a line on it and use that area as a zone, because sometimes price moves dirty and doesn't come all the way back to the golden zone. So we want to be able to have an area that price has already confirmed, and that's how we can do that. So once you have a volume breakout above the trend line, you can move all the way back up to your zone, and that's a pretty easy trade. Let's see how that happens. So once you see the breakout right here and you get a volume breakout of this trend line, you could be looking for a buy signal up to the top here to the golden zone. Remember, this is just a short-term scalp or day trade. You're not looking for the long-term trade because you're in a downtrend. You're really looking for price to get to this golden zone and then probably reject and continue down for your downtrend. Let's see what happens. So you get the nice little push to the upside, and it was right here that you'd want to take your buy. So you'd enter a buy right here. You'll see how price continues to move up, and you'll see that you're in profit. Price is moving up. You're looking really good all the way up to the top, and now price is in your zone and you see the rejection. So just like that, you see a buy signal, you get up to the top, and that is where you would sell. You would get out of the trade right there, and that would be where you would look for a sell to the downside. Let's see how that ends up. So you can see here, once price came and rejected our golden zone, we got a strong push down, we get some movement like this, but ultimately price comes and sets a new lower low. So now you have high, low, lower high, and a lower low. That trade right there would have been a beautiful downtrend trade. You can get the counter trend scalp, you get the rejection, and then you can take the sell to the lower low. That's how you use a Fibonacci retracement tool. But there's so many more techniques and so many more things you need to know. In order to find out more, go to my YouTube channel, Trade and Get Paid, hit that subscribe button, and learn how to use the golden zone or the Fibonacci retracement tool. When you see these sideways movements in the market, they're not just telling you nothing. They're very important. Let's talk about it. So you see the big drop off here. This is what we call a drop or a dump off. So price comes crashing down and then it consolidates. It's sideways and it's getting smaller, which is telling you that once it breaks out of this consolidation pattern, you can take a trade because you have a dump off, what we call a drop, a base. This is called a base, and then you have a rally. So you have a drop, base, rally. When you see that breakout right there, that is where you can get in for a trade, put your stop loss behind here, and then you just ride it back up to structure, which is right here. So you have a beautiful trade, drop, base, rally. What's awesome about that is that what was the rally on the first move becomes rally, base, drop on the next move, because the same way that the buyers got their money, the sellers want to get their money too. So price comes pushing up, you get a base pattern, another consolidation. As soon as you see the breakout right there, you enter, stop loss goes behind structure, and you can take it down structure and then previous structure. So you have rally, base, drop. Again, you see what was the first drop or the second drop on the first move. You have drop, base, drop. So it happens like that. Drop, base, volume breakout right there. Stop loss behind structure, down to the next structure. Drop, base, drop, drop, base, drop. And as you see that those are starting to get smaller and smaller, guess what? Now it's time for a turnaround. And what's awesome is that if you look, this drop right here, go look at it on the 4 hour instead of the 30 minute, and you will see that we have a drop, base, and probably a rally to come. That is how we trade base patterns. I have full videos on that on my YouTube channel and in my course on TradingGetPaid.com. Go to the YouTube, hit subscribe, watch my base pattern videos, and see if you can learn how to trade consolidation breakouts.